Welcome to A Canadian Investing in the U.S., a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to a new episode of Canadian Investing in the U.S. with Glen Sutherland. This week, my guest is Mark Halpern. Mark, you want to start off by just introducing yourself to everyone?
Sure. Mark Halpern, 35 years in professional practice. My company called wealthinsurance.com. We work with business owners, affluent families, entrepreneurs, people in the real estate business. We do three things. We do estate planning, we do tax mitigation strategies, often focused on tax-exempt insurance, and we also do philanthropy. We help people create legacies, often just by converting tax into charity. And that's something, when people are really successful, they kind of want to graduate into significance. So we like to help them do that as well.
Love it. Just for everyone who's listening, this is kind of a selfish episode for myself. I have some aging parents, and I've actually been looking into doing wills and, estate planning, and it just resonates personally with me. And I think that a lot of people are going to be able to pull a lot of stuff out of this. If Marcus has questions like, hey, about my situation, I'm open to sharing. So it's one of those things. We were just chatting beforehand about aging parents, estate planning. What do people screw up?
They screw up by not having a conversation like we're having with a professional, okay? Who can tell you about other screw ups so that you don't have that same trip and fall and scrape your knee when there's far less options available, right? It's kind of like the key message is do things while the sun is shining, okay? And also know what you don't know so that you can take care of it. So I come from this very honestly, Glenn, and that my father, of blessed memory, died when I was 11 years old. I was the youngest of four boys, and my mother had to go back to work at the age of 48 to support her family. Why? My dad was a busy engineer. He was a great dad, but he was also busy like everybody else. There was no will, very little savings. There was no life insurance. It was very hard for us. And my mother had to go back to work to support her family. So we had to really develop a struggle muscle, and I would not want to take that back. It's been a great struggle muscle, but you don't want to have to go through that. You'd rather learn it, in a more safe and flexible way.
So you just said something like, do things while the sun is shining. What do you mean by that? Is that like getting like a power of attorney or being able to do stuff? Or is it the way you set up your real estate or your investments or your parents' investments? What do you mean by that?
Yeah. So the first thing is, you wouldn't go to a doctor and get a prescription from them without giving them the details of your situation to get a proper diagnosis. Getting a prescription before a diagnosis, it's called malpractice. So really it's disgorging all that information. You wouldn't go to a doctor and not tell them about some growth underneath your shoulder or, a pain that or having trouble breathing going up the stairs. That would be dumb because then you wouldn't get the proper work. So I'd say that it really starts with sort of the ABCs of estate planning. Number one is if you're over the age of 18 and you have any assets, you should have a will. And again, most people right now, I'd say that something like 50% of Canadians, 52% of Canadians have a will. That means 48% don't. And the question is not on the people of the 42% that don't have a will, it's on the 50% that do have a will. Is it up to date? Was it done by a professional? Is there any discussion there around U.S. real estate or bequests so it's not like a cookie cutter for everybody else. But in Canada, if you don't have a will, the government actually has a formula for how your assets get distributed. So, of course, you want to know this, especially for your parents and even for you, Glenn, because I know you're married and you've got a couple of kids. But if you die and you don't have a will, it's called dying intestate. And the government says that if you have family, the first $300,000 will go to your spouse, and then the balance will be divided up between your spouse and your minor children equally, and your minor children's amounts will be invested by a public trustee in GICs until they hit 18, and then they get all the money. So imagine your biggest asset you leave, let's just say, is a $2 million house. So your wife's going to have $300,000 of that, and then there's 1.7 left over, divided up in three, and 2/3 of that has to be invested for your kids by some stranger. Like, who wants that? Nobody. So it's just ink on paper. If you have complexity, so then you might need to go see a lawyer to, do up a proper will. But you can even get wills online today if you have a very simple situation. You're a T4 employee and you've got a bank account and you've got an RSP and you've got maybe some assets that are in Canada, right? Then you could pull that off. But otherwise, it requires somebody to really do a deep dive and look at the big picture.
And so, with the situation you gave, I think it was like $2 million or $2 million house or something, whatever the number was, doesn't matter. But if it's not actual cash, right? If you have to split this up, that means you have to liquidate all these assets first.
Again, I don't want to give anybody any horror shows for that. You can go online to Netflix and look up the category of horrors. But no, there are horror stories. Remember, your kids are entitled to 2/3 of the remainder of that balance after $300,000. So again, it take care of this while you can. The other thing that some people should be looking at is maybe you don't need just one will. If you're incorporated, let's say you've got an operating company or holding company, then we have something called probate taxes in Canada, which basically said that if somebody dies and they're the only name on title of that property in Ontario, for instance, the probate tax is 1.5% of the market value. So if you got a house and you've put it just in your spouse's name because you're worried about litigation or creditors, and then that spouse dies, so on a $2 million house, you're talking about, 1.5%. You're talking about, $60,000 of tax that would be grabbed, or sorry, $30,000 of probate tax, which is an unnecessary state administrative tax. So what people will do is they'll look at having multiple wills. There's a personal will and a business will, or it's called a primary will and a secondary will. So again, just getting those in place, they can always be changed. Remember, it's just ink on paper. It's not like back in the day when we were growing up, Glenn, when you had you had to take the ink in the printer and print it off. So it's just worthwhile getting together with somebody to get something like this in place.
And like some people might be listening to this and go, "Hey, can't I just get insurance?" You always hear about people getting, term life insurance or whole life insurance to cover the spouse in this whole situation. I'm gonna bet you're gonna tell me that's not gonna be enough. You're gonna need this will as well. Are you interested in investing in the US? I honestly see Canadians making tons of mistakes, simple mistakes that could be avoided by just a quick phone call. Honestly, I think we should just get on a 15-minute call. You ask me some questions, I answer some questions, and I tell you a little bit about the coaching program. We see if it's a fit. My coaching program is completely different than other people's. What my goal is to help you actually implement the material. All the videos are pre-recorded, so you can just zip through those on your own time. But when you're actually buying property, this is what sets me apart, is that we actually sit down, you do your deal analysis, you have questions, ask me some questions. Let me go through it with you. Let me help you. And this is what's going to set it apart. This is why you're going to avoid mistakes. You're going to miss those little things that you just missed that could cost you a lot of money. Maybe I can see it. Maybe my experience. I've been doing this for a while down in the US. Let me help you. Let's do a quick 15-minute call. If that's of interest to you, go to glensutherland.com and you can book a 15-minute call. Anyway, hope this is helpful. Thanks, everyone.
Well, again, the insurance you would have, if you did take insurance out in Canada and you left it to a beneficiary of a spouse, as an example. So when somebody dies, and once it's determined that the person actually has died, then that money is going to go completely tax-free to the beneficiary of that insurance policy. But it still doesn't help us with regard to those minor kids. It doesn't help us at all with any tax planning. It doesn't help us with any bequests that you might want to make. It doesn't help us with any debts that are owed. In other words, insurance is just another aspect of planning that has to be done in estate planning 101. So wills, number one. Number two, powers of attorney. And you need to have two powers of attorney. One that says that if you become incapacitated, it allows somebody to take care of your personal finance. Another power of attorney lets somebody take care of your personal health. like you're again taking care of you. Now, likely it's going to be a husband and a wife, but let's say you're single, or let's say that husband and wife have a common disaster. Who steps in next to take care of those things? So that's why you need powers of attorney in place. I have two sisters. One of them was looking after their the mother had a stroke, so the father's looking after the mother. And then about 15 years later, the father had a stroke. So both parents are incapacitated. Two sisters come back to the country to take care of mom and dad, and they're not given access to anything. There's a trustee that's been set up. They can't even go to the bank and say, hey, that's my mom, that's my dad. Sorry, there's no power of attorney in place. And then
those are two separate things. Like you can't have one that does both, like the both the health and the wealth.
No, there's two powers of attorney. You have one for personal health care and one for property. And again, those are just basic planning 101s that you have to have in place. The other thing is you have to look at how things are owned. Like, are they in joint name? Are they in separate name? Are they owned by a corporation? All of those things have different ramifications in terms of tax and also access and probate and things. So, and the part that I think is really important for your listeners as well is people have to have what I call an estate directory, Glenn. What that is, you know, if I went up to your wife and I said, hey, do you know where all of Glen's stuff is? She maybe could figure it out, or hopefully you've been more evolved and you've put a list together. But, you know, and you might not have to know all of her stuff because you take care of it. But if you went bye-bye, is your spouse going to be into forensics, trying to find, like, where's the key to the safety deposit box, bank accounts, where are the deeds to the property, where are the codes, passwords to all my bank accounts and my affinity markets? Most of the time, it's all being rented in space between our two ears. So we really encourage people to put together an estate directory and put it someplace that somebody other than the two spouses know its whereabouts at all time, to make sure that if anything ever happens, you know, you don't have a tsunami happen.
Like, where would you recommend? Is that like, you know, having an attorney or a lawyer hold that, or like a CPA, or the bank deposit box, and you just have to have a key to it? Like, where would you recommend to hold that directory?
I call it different strokes for different folks, right?
Okay.
Often in a case of a young couple with kids, they would, let's say, give it to the trustee that would be in charge of the kids if something happened to them. So it could be a brother-in-law, a sibling. You know, next step would be, other than that, it could be a professional. It could be a very dear accountant or lawyer that they work with and is a trusted advisor. It could be that they put it in the ice tray in their freezer and tell somebody, if the house ever burns down, don't worry, all the documents are in the freezer, so we'll be okay. It really all depends. And then even in the format, it could be a written form or it could be a digital form. The point is getting that into place gives you tremendous peace of mind, knowing that things are organized and put together.
If you're a Canadian interested in U.S. real estate, there's a 60-second quiz that will tell you the safest strategy based on your specific situation. Because here's the thing, there isn't one way to invest in the US as a Canadian. The right move depends on your budget, your risk tolerance, and what you actually want to get out of this. Most Canadians I talk to are stuck in the same spot. They know the US opportunity is real, they've done some research, but they're sitting on cash because they don't want to guess their way through setting up corporate structures, cross-border taxes, and picking the wrong market for the first deal. The mistake isn't lack of information, it's that generic US investing advice doesn't account for your situation as a Canadian. It doesn't account for your capital, your timeline, and your appetite to be hands-off or hands-on. So we built a 60-second quiz that gives you a personalized answer. Which US investment strategy fits you right, whether you're actually ready to buy or what to fix first, and the smartest next step based on where you're at. It's free, it takes about a minute, and you'll get a customized game plan at the end. And it's not a generic PDF. Go to CanadianInvestingInTheUSA.com/quiz. It's also linked in the show notes. Take the quiz, get your game plan, stop guessing. You don't need to figure this out alone. You just need to know what your next move is. That makes so much sense.
And then that reminds me, Glenn, what you talked about with regards to insurance. You know, when you do get your will done, it instructs your executors to pay off all outstanding legal fees, accounting fees, trust fees first, before anything goes to your family. If you're married, you're fortunate in Canada because everything rolls over tax-free to your surviving spouse. Taxes are not due until the second to die of a husband and wife, which means that if you're single, widowed, or divorced, you're biased against because there's a taxable disposition that would happen as soon as you die. So the key here is to do some planning with a financial advisor to sort of make sure that you get a big check mark, meaning, we're going to be okay financially, based on all these assumptions and my retirement, but what's the tax bill today if we both go bye-bye? And then based on life expectancy, let's say we go to age 90, 95, what are we going to have left? What's going to be the tax then? And now when we meet with somebody like Mark Halpern, can we use some of that never spend money that's just going to tax to preserve the estate for my family or for charity or for both? So it's all about planning. Planning is something that unfortunately people love investing. They love the returns and the ROIs on your Alabama property or Toledo or wherever the case might be, but they don't look at what are the consequences of selling that and having a disposition and now having a tax bill. So, but there are a lot of people there, and certainly in the real estate, they're either buyers and sellers or they're buyers and holders. A lot of the people today, or at least the old timers, they like to buy and hold because they look at it as the value keeps going up. Their equity keeps going up. They have this nice, I call it the cow. The cow is giving you this wonderful milk, right? Why kill the cow? But at the end of the day, the government's they're going to have their handout and they're going to want, between 25% of all your gains, right? Of all your gains, they're going to have their handout. And how are you going to pay for that? You're going to say, okay, which one of these properties do I have to sell now to pay the tax, right? And is it a good day to sell it? Somebody's going to know there might be some sort of a crisis here, so I can buy it at a cheaper amount. But the point is you're going to have to come up with money. And the best way to come up with money is through the use of tax-exempt life insurance. It's inexpensive. You can buy it for pennies or even on a cash flow neutral basis. And now when you need the money for taxes, instead of having to sell assets, you got this insurance asset in place that goes ahead and pays the tax man. But it's all part of planning.
So many things just popped in my head from that. Is there a way to do like that insurance with like your corporation to be like the beneficiary and instead of like a person so that you could just keep the money kind of in the corp to pay the taxes for transferring?
I feel like you're throwing me a softball on that one, Glenn.
Oh, is that a softball?
No, because if it's not, that I should have given it to you. Look, there are two. If you're in business, as your listeners are, you generally have you generally have two checkbooks. You have a personal checkbook and you've got a business checkbook. Yes. And we all know we love to use that business checkbook as much as possible because to get money out of your corporation, you have to get like $1.50 from your corporation to get $1 out to yourself, right? Right. In other words, it's just the way it works. But you can actually own, as you said, Glenn, so correctly, you can actually have corporate-owned life insurance where the corporation is the owner, the beneficiary, and the payer, and you can use after-tax corporate dollars to fund insurance premiums. And business owners have to know that there's a very special notional account that they have called the CDA, the capital dividend account. And whatever goes into that capital dividend account comes out of the corporation tax-free. And life insurance is one of those special assets that goes into the CDA, the capital dividend account. And then all the insurance can be extracted tax-free to yourself personally. So it's kind of like a tax-free pipeline to turn corporate dollars into personal dollars. So the good news is by doing something like that, you now have the money to pay the taxes as opposed to having to sell your real estate. And at the same time, you've actually acquired it in a very cost and tax efficient way. And even taking it one step further, Glenn, there are people who use financing strategies to acquire their insurance. And it's kind of like, we call it virtual real estate. So, in your world, there's real estate and you have something called a market value and you have equity. And for very astute real estate owners, the market value keeps going up, hopefully, and the equity goes up. And what happens is you can go to the bank to borrow against that equity to go ahead and invest in more real estate and have some deductions attached to that. And that's how people create big money or big wealth in real estate. So in life insurance as well, when you're talking about estate planning and estate tax, there's something called permanent life insurance. And permanent life insurance has qualities like real estate. It has the death benefit. That's like the market value. And then it has something called the cash surrender value. That's like the equity. So when you put money into an insurance policy that's a tax-exempt permanent insurance policy, you have this insurance in place, but the equity is equal to almost the amount of money that you put into the policy. And you can borrow that money up to 100% right away to now go ahead and buy real estate with it. Because you're borrowing to invest, you can deduct the interest and the net cost of the pure insurance. And now you have insurance to take care of your estate planning, but you've also had the money to continue to invest in your real estate. So it's kind of like having two assets for the price of one. Now, of course, you borrowed money from the bank. How do you pay that back? Well, the life insurance will pay back the bank. So now you've got the bank all covered, and now you've got the insurance in place to take care of your estate planning or your legacy planning. So again, no situations are the same. And I realize I'm getting into the weeds a bit, but it really means sitting down and sort of looking at your own personal situation, figuring out what makes the most sense.
Love it. And this makes all right. So where are you located? Like if someone's like, hey, this is something I'm interested in, where are you located? Can people work with you here on these kind of?
Absolutely. I mean, I'm in Canada.
Yeah.
So we work across the country. I'm located in northern Toronto. Okay. People can go to our website, wealthinsurance.com. They can call us. There's no meter running for a conversation. We also have advisors available across the country to either Zoom, meet in person, whatever the case might be. But there's no loss to anyone in having a conversation. And we work with clients, professionals all the time, including their insurance professionals. Like we're not a territorial group. We just want to basically help people. But at the end of the day, people see that we're smart and we're capable and we're trustworthy. And they say, you know what? I need somebody like you on the team. And that's another good point, Glenn.
Yeah.
People need a team. You need a team of professionals.
The
world has become so complicated and everyone has ADD, and people have to be speaking to each other. So you need a good lawyer. You need a good accountant. You need a good investment person. You need a good insurance person. You need a good banker for credit. And you need a philanthropy person also. And everyone's got to be speaking to each other. So we just like the idea. If we can be part of somebody's team, I think we'll bring them great value.
Love it. So, okay. People are like, okay, I'm in Canada. I'm looking for these services. Is there a website? Is there a phone number? How do they reach out to you?
They can go to wealthinsurance.com. They can send me an email to Mark, M-A-R-K, at wealthinsurance.com. They can call me, 416-871-4357. We love WhatsApp. So go ahead and connect me on WhatsApp. Send me a voice message. Again, we're more than happy to speak to your friends and family, Glenn. That's for sure.
Well, Mark, this one was awesome. For me, it was very timely, and we're going to be doing some more talking because a bunch of the things you mentioned there are things that I've been planning to set up and haven't fully got to the finish line. So thank you so much for your time and the knowledge. And I think anyone listening to this who lives in Canada, which is 95% of the people who listen to this podcast, is going to be, at least for me, it was a ton of value. Thank you so much.
Thank you so much, Glenn, for having me. And as it is for you, you're a youngster like me. We're still young families, but you're spot on. You talked about aging parents. That's a whole demographic. Hey, if they haven't done the planning that you have to do for yourself, imagine what you're going to be inheriting in terms of a mess or a tax burden or a friction at a time when it's very emotional, and you don't want that. You want to know that things are in place. So I think you're doing everybody a favor by passing this message along. So I appreciate you having me.
Well, thank you so much.
That was a nice video. Bye.